Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we will be doing technical analysis on the S&P 500 for Thursday, May 21st, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were down 78 basis points on the S&P 500 and closed at 2948.51. The first chart that we're looking at is a 5-day, 5-minute chart of the S&P 500. So each candlestick represents 5 minutes of trading. And what we can see here is for the last 4 days, basically we've kind of gone sideways on the S&P 500. Now, if you listen to the talking heads on CNBC or Bloomberg or Fox or whatever, they're going to talk about how great this week has been. The reality is that most of the gains this week happened in the gap up on Monday's trading. So this is last Friday. This is Monday, of course, Monday, Tuesday, Wednesday, Thursday, if you can see where my cursor is. And so on Monday's open, you can see here that that really is responsible for most of this week's gains. And this is why I like to look at these short-term charts so you can really see what is happening inside of the market. This next chart that we're going to look at is a 20-day, 30-minute chart of the S&P 500. So each candlestick represents 30 minutes of trading. The two blue lines are set at 2800 and 2960. So what we can see here is after we gapped up on Monday's open, we came up and Monday and Tuesday traded right up against this 2960 area on the S&P 500. Yesterday on Wednesday, we were able to trade above it and closed above it. We can see where we closed on this dotted blue line. That's yesterday's close. Well, today, of course, we could not hold this 2960 level and fell beneath it and, of course, closed at 2948.51. So now the question is, how much is this 2960 area going to hold us back? We've tested it and we failed and we could not hold that 2960 area. So will it be a big deal going into tomorrow on Friday? Only time will tell here, guys, but I don't like the looks of this. When you test an area that has been, at least in the short term, some overhead resistance, you test that area and then fail. That, to me, could present a problem, at least in the short term. So we really do need to keep our eye on this 2960 level, and tomorrow's trading action might be somewhat telling. Are we going to break down from here? You can see that we really have been trading above this 2950 area as well, kind of flatlining right around in this area. So, tomorrow will be important. Will we hold this 2950 or will we start to gap down during tomorrow's trading? The other thing to note here is going back to April 29th, and this is going to be important for many of the charts we're going to look at here over the next few minutes. But on April 29th, you can see we got up and we traded right up to this 2955 level intraday. Well, that is the same level that we've been trading at since April 29th. So how much progress have we made in the stock market, in the S&P 500 since April 29th? Basically, we've been flat, okay? I mean, there's been some volatility. We've been up and down, but we have been at this same level in the S&P 500 since April 29th. This next chart that we're looking at is a very similar chart. It's a 20-day, 30-minute chart. However, this time we're looking at the Dow Jones, for those of you who like to follow the Dow. And what we can see here is a very similar pattern over the last 4 days. We've been basically trading sideways, and where we're at now is actually lower than where the Dow hit on April 29th. Now we're looking at another very similar chart, again, another 20-day, 30-minute chart. This time we're taking a look at the IWM, which tracks the Russell 2000 Small Cap Index. And what we can see here, again, is a very similar pattern, however, just slightly upward. So we're seeing a little bit better price action out of the small caps this week than what we've seen for quite a while. And they're actually in a slightly upward trajectory versus what we're seeing in the large cap. So that is at least a small win. That I like. I like that slightly upward trend that we're seeing in the small caps. However, they are still trading beneath where they hit as far as the highs that they hit on April 29th. So what happened on April 29th that pushed a lot of these indexes, a lot of these capitalizations to the highest point that we've seen so far? Well, that's when Gilead hit its high, right? GILD, Gilead Sciences, where Gilead hit its high on the promise of a potential treatment for the coronavirus. And you can see here that on this 20-day, 30-minute chart of Gilead, that was the high. There was a ton of volume that came in on GILD. That was the high of the stock so far in the last month or so, and it pulled back, and it's been in a downward trend since. So the luster is wearing off of Gilead, and that is the reason why a lot of these charts peaked on the 29th and have not been able to make new highs since. Next, we're going to look at a 6-month chart of the S&P 500, where each candlestick represents 1 day of trading. And of course, we have the orange line, which is the 200-day moving average. And we have not been able to get back above the 200-day moving average on the S&P 500. And we're seeing the same thing in the Dow. The Dow is trading well below its 200-day moving average, and the same thing for the IWM, the Russell 2000 small cap. The Russell 2000 is trading well underneath its 200-day moving average, and look at how that 200-day moving average is downward sloping on the Russell 2000. So this stock market is still not very strong, folks. Okay, be realistic about what's really happening out there. Most of this week's gains happened at the open of trading on Monday, and then we've been predominantly sideways. And at this point, there are so many things that can go wrong, and there's only a few things that can go right. The market may have gotten ahead of itself here, and let's be realistic about what's happening. Okay, so please be careful. If you are long this market, keep your stops tight. Maybe rebalance your portfolios, take some profits that you made over the last week or two, but just remember that we've been predominantly going sideways since the open on Monday. And as we've seen, a lot of the trading peaked on the 29th of April, and we've been basically sideways since then with a lot of volatility. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Thank you for watching today's video. Before you leave, don't forget to subscribe to this channel. Please give me a thumbs up on this video and check out my other YouTube videos. I have a lot of great videos on my YouTube channel. And if you would like to learn more about how Simple Market Signals can help you in both up and down markets, you will want to watch these videos that are linked in the description box below this video.